What's up, traders? Welcome back. Today we're going to be talking about risk management and position sizing. These go hand in hand, so let's jump right into it. This is a very important aspect of the market, and a lot of people tend to ignore this, which causes a lot of emotional distress and a lot of financial distress along the way. So let's jump right into it, and hopefully I can break it down for you guys in a way where you can use it to your benefit and find some value. So let's go. So position sizing. Position sizing is the part of your trading system that tells you how many shares to buy or sell per trade. Position sizing will help you determine how many shares to go long or short with for a particular trade, your risk per trade, and overall risk to your portfolio, your expected returns to your portfolio as well. So now, this little chart on the side is an opinion, not really a fact, but in my sense, I feel this fits me perfectly. That trading is more psychology than anything else because it's all about how you react to your trades, right? Anybody could take a trade, but it's about how you react when you're in it and the way you go about it. So, in a sense, it's 10% strategy, 30% position sizing, which I'm going to show you about, and 60% psychology. So, why is that? Let's look. So steps to calculating your position size. It may look a little all crazy mathematical right now, but I assure you I'm going to break it down in a way where it's very, very simple. Basic math. So step one, we need to calculate our capital, which is our net liquidation on our whole account. So that's our shares plus our cash that's in the account. So for example, let's say we're starting with a $10,000 account, right? How do we determine our risk per trade? How are we going to determine what we're going to risk per trade that we take, right? It's not going to just be a random distribution of risk, right? So risk refers to the maximum loss per trade, right? This is the maximum you can lose if your stop loss is hit. This loss should never be more than 1% to 3% of your capital, right? So in other words, never risk more than 1 to 3% of your capital on any one investment. So for this video, we're going to be using risk per trade of 1%, right? 3% is more on an aggressive side, especially on a $10,000 account that you're starting with. You don't want to risk $300 per trade, right? Especially if you're new and you're a beginner, you're not necessarily going to want to take on that risk. So for this example, we're using a $10,000 account with a 1% risk, which is a $100 risk per trade. Now let's jump into the math. So to determine our position size for each investment, to find the number of shares that we must buy, this is the formula that we must use, right? So when we're buying shares, we're not going to just be like, you know what, price is at $10. I'm looking for a $2 jump. I want to make $200 today. Let's do it, 100 shares. That's completely wrong, right? You don't just pick a random amount of shares. It has to have a mathematical formula behind it to make sense, to give you an evenly distributed amount of wins and losses, so we can ensure that we're profitable at the end of each month, week, whatever it is. So now, example one, we want to go long on Bank of America, right? We want to buy Bank of America, and I'm going to get into another video on how we pick entry prices and how we pick where to put a stop loss and where to put a profit target. But for this video, we're going to pretend like we already determined these factors and our entry price, stop loss, and profit target is already determined. So for our entry price of $8.60, right? Let's pretend we calculated the reason why we're putting our stop loss at $7.90, and we calculated why our profit target is at $10. Let me explain what this means, right? So, when we're determining our position size for each investment, we're looking at a 2R or minus 1R, right? We're either adding 2R or we're minusing 1R, right? What I mean by R is return, is risk or reward, right? So we either want to make $2 or we want to lose $1 per trade. So now let's take a look right here, right before we jump into all of this stuff. So as I said in this last slide right here, if you look, our buy entry is $8.60. This is where we're going to buy, right? So now we determined where we want to buy at, which is $8.60. We determined where our stop loss was going to be at $7.90, right? And our profit target is at $10. Now, why did we put our profit target at $10 and why did we put our stop loss at $7.90? I'll explain. So if our stop loss is at 790, if you take $8.60 and minus $7.90, there's 70 cents of risk per share that we buy, right? Per share that we buy. So if we're risking 70 cents per share, we need a 2-to-1 ratio. So for every 70 cents that we risk, we want to make $1.40, right? Because 70 cents times 2 would be $1.40. Hence why we put our profit target at $10, because 860 plus $1.40 would be $10. So you see how that 2-to-1 ratio comes in. So for this specific trade, if we're right, we're winning 200. If we're wrong, we're only losing 100. But now, how many shares do I buy? That's the question. Great, you told me the math behind it, but how many shares do I buy to ensure my capital is protected on every trade? So let's take this formula here. Number of shares equals, so now the number of shares you're going to buy is going to equal the percent risk per trade times your capital divided by the risk per share. So now let me show you how we're going to plug in the formula. So we're going to buy Bank of America. We're using that 1% risk that I told you that we're using the example of. So let's pretend we're only using a 1% risk. And that's going to be our consistent percent risk per trade every single time. We're not going to switch up and go 1% this trade, 3% this trade, 2% this trade, 3%. No, that's inconsistent. We do 1% for every single trade, or 2% for every single trade, or 3% for every single trade, whatever fits your trading style, right? So now we're using 1% of risk on our $10,000 account. So 1% times our $10,000 capital in our account is $100, right? Now we take our 70 cent risk per share and divide that by our $100 risk on our entire account, right? I mean, on our entire trade. So now, if we take the 70 cents of the risk per share and divide that by our $100 risk per trade, right? This is risk per share. 70 cents is the risk per share. $100 is the risk per trade. You see the difference there? Don't get confused with that. So now if we do 70 cents divided by 100, we get 143 shares. Now, what does that mean? Okay, we're going to buy 143 shares. So if we did 143 shares times 70 cents, let's say we lost 70 cents times 143 shares, we'd only be losing $100, right? Which is right here. If we did $1.40, which is our profit per share, if we did $1.40 times our 143 shares, we will return a $200 win. So if we stay consistent with this 1% ratio and we always calculate our risk per trade and our risk per share, we will always have a consistent return and a consistent loss all the time, right? So now, if we look at the whole position, we're entering in $8.60 times our 143 shares that we calculated over here to give us a total position size of $1,229.80, right? So now, just because we invested $1,229 doesn't mean we're gonna lose all of that. The only amount we would lose if everything goes wrong is $100. $100, not $1,200. $100. That's where a lot of people go wrong. They get scared, like, oh, I'm investing $5,000. I'm investing $10,000. Yes, it doesn't mean you're going to lose your entire investment, right? You only lose what you calculate your risk management to be. So now let's go to the next slide. So now I'm going to give you another example. In this case, we're going to do a short example. So with that being said, I'm going to show you from the short selling side instead of the going long side. So for those of you who don't know, when you short a position, you're making money on the stock going down. You're basically buying high, selling low, but in a sense, it's opposite. You're selling high and buying back low, right? So let me explain this. It's going to have the same exact formula as you can see here. Percent risk per trade times your capital divided by your risk per share. Very, very basic math. You guys definitely seen a lot more harder formulas in math class, college, whatever it is, right? So let's go to example 2. You want to sell short JCPenney at your entry price is going to be $16.50, right? That's where you're going to sell short those shares. So you're going to sell high at $16.50 mark. Your stop loss is going to be 1860, which is above your entry price, right? Because you're basically betting saying that, hey, the market's going to go down. So as the market goes down, you make money. If the market goes up, you lose money, right? So now our profit target is going to be set at $12.30. So let me reiterate that for you one time. The entry price is $16.50. Our stop loss is above that at $18.60. And our profit target is below our entry at $12.30 because we're making money on the stock going down. So now, let's look at the calculations. So, if we look here, our sell entry, that's where we're going to place a sell at $16.50. If the stock goes down and it's our profit target, our profit per share is $4.20. So if we're looking to make $4.20 per share, we can only lose $2.10 per share. Why? Because if you take $2.10 and multiply it by 2, that's $4.20. So in essence, we will only lose $100 again, or we will only win $100 again to the downside. So in this example, I'm going to say it again, we're making money on the stock going down, and we lose money on the stock going up because we're short selling. So now that our entry price was at $16.50, right, and our stop loss is at $18.60, we have a $2.10 risk per share. So now let's plug it in to the formula again. How many shares can we short sell? So we take our 1% of our risk on the entire account, right? Our 1% risk per trade, right? And we multiply it by our capital, which our entire capital of the account is $10,000, right? We get, again, $100. We're only allowed to lose $100. But now if we look at our risk per share of $2.10, right, we divide that by $100, which is our risk per trade. So our risk per share, $2.10, divided by our risk per trade, which is $100, gives us negative 48, right? And we got negative 48 because we're shorting 48 shares. Don't get confused by the negative. Oh, it's negative, but there's no negative numbers being multiplied or divided. When you enter in a short position, you're borrowing shares that you don't own, right? And then when you buy them back, you're buying those shares to get to a break-even point. So let's say you shorted those 48 shares. You're now negative 48 shares. And then once you buy back 48 shares, you're back to zero, right? I'm going to break down a whole nother video on short selling, but for right now, let's focus on position sizing and risk management. So now that you understand, we got the 48 shares. But if we take 48, forget the negative, 48, and multiply that by $2.10, we get that $100 risk. So if we lose $2.10 on our risk per share, on our 48 shares that we went short on, we only lose $100. But now if we went against our plan, and let's say we decided to double up on those shares and buy 100 shares, okay, now you're going to be losing $210, or you're going to be winning $210. So what you would have to do is you would have to increase your profit target and increase your stop loss, but that is stupid. I do not suggest doing that. That's what an amateur does, right? If you want to be a professional trader, and I'm by far professional. I'm not a professional, but I'm on my way there, right? Even somebody who is professional would not take a risk like that, right? An uneducated risk. So JCPenney position, we got in at 1650 times our 48 our short 48 shares gives us 792, right? So we paid $792 to short this position. And yeah, so we are not going to risk this entire $792, right? That's where a lot of people have a misconception. The only thing we're risking is $100. So guess what? If everything went wrong, we're going to return to our account $692, right? If everything goes right, we're going to return to our account $992, right? Because we have $200 of profit in there. So let's hop to the next slide. So let's say you wanted to take on multiple positions, right? Excuse me. You want to take on multiple positions, and you calculate the same exact risk and the same exact reward per each position. You see how each position, and look, Bank of America, short in JCPenney, long in McDonald's, long in Apple. See how they all have different costs, obviously. But the cost does not matter. What matters is how much we're losing and how much we're making. So if we risk 1% of our Bank of America position, we're only going to lose $100. If we win in our Bank of America position, we're going to be up $200. Same concept for each of these. Minus 1% would be minus 100, minus 100, minus 100, and minus 100. Hence, we would get a minus 4%. If we lost all of these positions, we would only lose $400. If we won all of these positions, we'd be up $800, right? Yeah, 2, 4, 6, 8. We'd be up $800. You see how the 2-to-1 comes in? I can't stress it enough how the 2-to-1 ratio is extremely important. And now, just because I say 2-to-1, you don't necessarily have to always stick to 2-to-1. If a 3-to-1 works best for you, or a 4-to-2 works best for you, or a 10-to-5 works best for you, you do what fits your trading style best. But what I'm trying to explain to you is you need a set, consistent risk reward every time you trade based on your own style, right? So even if we lost 2 of these, we'd be down 2%, right? So we only risk 2% and we would only make 4%. You see how it always balances out? So we would have risked 2% to make 4%. I really hope you guys understand this chart because it just really breaks it down for you guys. So now, why do I keep using R, right? R multiples. The concept of R multiples is a successful trader thinks in the terms of R multiples, not money, right? So you'll often hear amateurs say, oh, I made this much today. I made this, I made that. Great, that's awesome. You made that money. But when you're in the trade, you don't think in terms of money. You're not going to say, you know what, I want to make 200 today. I want to make 400 today. You say, you know what, I want to make 2R today, or I want to make 2% today. I want to make 4%, right? You give yourself a percent range because that's how you can gauge where you're going to take profit and where you're going to sell, right? Where your stop loss is going to be, so you could completely take the emotion out of it. Okay, so now 1R is a unit of risk. 1R also equals the maximum risk per trade, which is either the 1 to 3% of your capital, right? So if we're risking 2R, that means we're risking 2% of our capital. If it's 3R, 3% of our capital. You get it? So a losing trade results in negative 1R, right? That means we lost 1R. We lost 1%. A winning trade results in plus 2R, positive 2R, right? Or more, because that means we gained 2% or more, right? So now, obviously, if the trade's running, you're letting it run, and you hit that 2R mark, you're up 2%, doesn't mean you have to, boom, sell out immediately. What you could do is, if you see the bull still have control and price is running up, have a trailing stop loss on. You see what I'm saying? Follow price all the way up. At least you could secure 2R. 2R is the minimum you want to take. But max could be infinite, obviously, right? It would be great to risk 1R and take 10R, 20R, 30R, right? But you take what you can get and you don't be greedy. So if you trade off of a consistent risk-reward ratio using 1R and 2R, you could still be profitable with a 50% win rate. How? Let's see. So, how can we build a consistent income from the stock market? Isn't it gambling? Of course it's gambling. So overall, yes, we are taking on a gamble when we trade, similar to casinos. We as traders use a risk-reward system to make sure we have a statistical edge over the market. Casinos have a 5% edge on every game that's played in their business. Have you ever thought about how casinos always turn a profit day after day, year after year, in an industry known for gambling, which has uncertain odds? The same situation with trading. We only put on trades that have a higher probability of working in our favor. We don't blindly enter a trade in hopes of a return. That's simply uneducated gambling, and you are bound to lose your money. Just because the edge may be in our favor does not mean we are sure to win. But if we lose, we know exactly how much we are losing or winning per trade in a consistent manner, right? So losing money is not a problem. If you have a consistent plan every time you lose, make 2 when you're right, lose 1 when you're wrong. Hence the 2-to-1 risk-reward ratio, right? So now, before I go on to the next bullet, I want you to think of this. Don't think of losses as you lost. Even though, yes, you lost, think of it as a business expense, right? You literally paid to play. That's what it is. You paid to play, and you paid the cost that you were willing to pay to play and see if you were right in that trade. So now, next bullet. With consistency in your trading plan and your set risk management rules, you will never take on a loss that exceeds your criteria unless price blows past your stop loss for specific reasons. In that case, you place a market sell order immediately to exit the trade. Never push stops back more and more in hopes of it moving back up. Now, it's not going to often blow past your stop loss. That doesn't happen on a regular basis. But if the market's very volatile and it blows right past your stop loss, no one's willing to buy at the price that you're selling, it could happen, right? Nothing's impossible in the market. Anything can happen. You must live by that in the market. Anything can happen. So now, winning only 50% of the time could still make you very, very profitable. How? So, 50% win-loss ratio and still profitable, right? Let's say trade 1, take 100, trade 2, you lose 100, trade 1, take 100, trade 2. Lose 100, lose 100, make 200, make 200, make 200, lose 100, make 200, lose 100, right? So now we can see we lost 1, 2, 3, 4, 5. We lost 5 times and we won 1, 2, 3, 4, 5. We won 5 times. So we lost 5 times and we won 5 times. That's a 50% win rate, right? And a 50% lose rate. So how does it come out? Do simple math. 100, 200, 300, 400, 500. Our losses totaled up to 500. Our wins totaled up to 2, 4, 6, 8, 10 to $1,000. At the end of the day, we had a net return of $500, even though we only won 5 out of 10 trades. You see, so it's common sense, really, right? It's basic math, but you just have to have a strategic plan and set to make sure that the math works out. Because if you don't have a proper risk reward ratio, what's going to happen is, you may win a lot, you may lose a lot, and you may be 70% profitable, 70% win rate, 80% win rate. That doesn't mean you'll be profitable, because if you have inconsistent balance of wins and losses, let's say you make 1,000, you lose 1,500, you make 800, you lose 5, you make 5, you make 5, you make 5, you lose 15, you make 10, you're all over the place. It's not going to balance out right, and the numbers are not going to make sense, right? Numbers never lie. So always keep that in mind, and don't think you have to be right 100% of the time. Everybody, have a blessed week. I really hope this video has helped you. I'm going to be making more videos on position sizing and get more into depth of how I actually set up risk management in the trade itself. So I'm going to be doing live trading videos very soon, so you can see how I take my trades, what I do pre-market, my morning routine, and how I set up risk management. Everybody, have a blessed week. Thank you very much for watching. Subscribe, like, take care, and don't forget to follow Billy Talks Business for more trading tips and clips. Have a blessed day.